ECO202. Welcome to study session 8, International Trade. Introduction. In the realm of trading for economic purposes, no country is an island. There are trade relations between one country and another. In this study session, we shall discuss the basic theories of international trade, the reasons why countries engage in trade, and the barriers to international trade. Learning outcomes. When you have studied this session, you should be able to point out the reasons why countries engage in international trade, analyze at least 2 theories of international trade, present terms of trade, highlight various restrictions to free flow of trade among nations, discuss the classification of balance of payments, show how exchange rates are determined in the real world. A rationale for international trade. Just as individuals trade among themselves, nations also engage in trade with one another. This trade between one nation and the rest of the world is called international trade. Nations engage in trade for various reasons. In the first place, trade permits specialization, and specialization increases output. Because a country specializes in the goods it produces particularly well, it can trade them for goods that other countries are especially good at producing. Thus, both the country and our trading partner benefit. In addition, some countries have more and better resources of certain types than others. Nigeria has oil, Canada has timber, and Japan has skilled labor force, and so on. International differences in resource endowment and in the relative quantity of various types of human and non-human resources are important for specialization. Theories of international trade. Absolute advantage. This theory was propounded by Adam Smith to explain the reason for trade. This theory can be illustrated as follows. Assuming that there are 2 countries, A and B, and also 2 commodities, X and Y, with the same quantities of resources. If country A can produce more of commodity X than B, and then country A is said to have absolute advantage over country B in commodity X, while country B has an absolute advantage in commodity X. The 2 countries will benefit from trade if country A has absolute advantage in commodity X, while B has absolute advantage in commodity Y. A numerical example with suffix. Suppose Nigeria can produce 1 electronic computer or 10,000 cases of wine with 1 unit of resources. Suppose that Japan can produce 2 electronics computers or 5,000 cases of wine with 1 unit of resources. If Nigeria shifts 1 unit of its resources from producing computers to producing wine, it will increase its production of wine by 10,000 cases and reduce its production of computer by 1 computer. On the other hand, if Japan shifts 1 unit of its resources from producing wine to computer, it will increase the production of computer by 2 computers and reduce the production of wine by 5,000 cases of wine. Table 8.1 shows the net effect of this shift in the utilization of resources on world output of computers and wine. Case of absolute advantage. Effect of Japan's shifting 1 unit of resources from wine to computers. Reduction in the production of wine and increase in the production of computers. Effect of Nigeria shifting 1 unit of resources from computer to wine. Increase in production of wine to 10,000 units and reduction in the production of computer by 1,000. The net effect. The global output for wine increases by 5,000 and the global production of computers also increases by 1. Thus, we can see from the table that world output of both wine and computers have increased with trade. Therefore, in this situation, Nigeria should specialize in the production of wine, while Japan must specialize in producing computers. Comparative advantage. This theory owes its origin to David Ricardo. This theory is an extension of the absolute advantage theory of trade. The theory maintains that even in a situation where a country has absolute advantage in producing the two commodities over another country, trade could still occur provided that there are differences in the relative efficiency in producing the two commodities in the two countries. A numerical example will make this point clear. Let us make adjustment to our earlier example. Suppose Nigeria can produce one electronic computer of 4,000 cases of wine with 1 unit of resources, while Japan can produce 2 electronic computers and 5,000 cases of wine with 1 unit of resources. In this case, Japan is more efficient in the production of both computers and wine. Nonetheless, as we shall see, world output for both goods will increase if Japan specializes in the production of computers and Nigeria specializes in the production of wine. The table below demonstrates this conclusion. If 2 units of Japan's resources are shifted from wine to computers, 4 additional computers and 10,000 fewer cases of wine are produced. If 3 units of Nigeria's resources are shifted from computer production to wine production, 3 fewer computers and 12,000 additional cases of wine are produced. Thus, the combined effect of this reduction of resources in both countries is to increase the world output of computers by 1 and to increase the world output of wine by 2,000 cases. We can see from the above that even though Japan is more efficient than Nigeria in the production of both computer and wine, world output of both goods will be maximized if Japan specializes in computers and Nigeria in wine. Basically, this is so because the degree of efficiency of Japan in the production of both goods differs, is twice as efficient as Nigeria in producing computers, but only 25% more efficient than Nigeria in wine. The theory of comparative advantage forms the basis of trade among nations. A nation has a comparative advantage in those products where its efficiency relative to other countries is highest. However, unlike the prediction of these two theories, what we have in real life is incomplete specialization. Terms of trade. The phrase terms of trade is defined as a quantity of imported goods that a country can obtain in exchange for a unit of domestic goods. It is the ratio of the price of export to the price of import. In the above table, it is possible for Japan to produce 2,500 cases of wine by giving up 1 computer. Thus, the ratio of domestic exchange should be 2,500 to 1. Similarly, Nigeria can exchange a case of wine for 1 to 4,000 of a computer by diverting its own resources from wine to computer. Thus, while Japan will not be willing to exchange 1 computer for less than 2,500 cases of wine, Nigeria will not be willing to exchange a case of wine for less than 4,000 of a computer. But where will the price ratio lie between 2,500 to 1 and 4,000 to 1? The answer depends on world supply and demand for the two products. The stronger the demand for computers relative to its supply, and the weaker the demand for wine relative to its supply, the higher the price ratio, and vice versa. Openness in financial markets. Openness in financial market allows financial investors to hold both domestic and foreign assets, thus to diversify their portfolio and to speculate on movement of foreign versus domestic interest rates, exchange rate, and so on. Given that buying and selling foreign assets implies, as part of the operation, buying or selling foreign currency, the size of transactions in foreign exchange market gives a sense of the importance of international financial transactions. In 1994, the daily volume of foreign exchange transactions in the world was $1 trillion, of which 80% and above, 800 billion naira, involved dollars on one side of the transaction. Most of the transactions are associated not with trade, but with purchases and sales of financial assets. The volume of transactions in foreign exchange market is not only high, but also rapidly increasing. For a country as a whole, openness in financial markets has an important implication. It allows the country to run trade surpluses and trade deficits. Recall that the country running a deficit trade balance is buying more from the rest of the world than it is selling to the rest of the world. Thus, it must borrow the difference. It does so by making it attractive for foreign financial investors to increase their holding of domestic assets, in effect to lend to the nation. Barrier to international trade. In this section, we shall discuss the various restrictions to free flow of trade among nations. The restrictions are collectively called barriers to trade, and they include tariffs, quotas, export subsidies, licenses, and so on. The net effect of these barriers is that they make domestic prices to be different from international market prices. Despite the advantage to be derivable from free trade, experience has shown that not everyone benefits equally from free trade. Thus, for various reasons ranging from reasonable to spurious ones, countries impose restrictions on free trade. Such restrictions include tariff, quota, subsidy, and other non-tariff barriers. Tariff can be defined as a tax which the government imposes on imports. Usually, the purpose of a tariff is to cut down on imports in order to protect domestic industries and workers from foreign competition. A secondary purpose, however, is to generate revenue for the government. On the other hand, quota refers to the maximum amount of certain commodities that can be imported annually into the country. Finally, export subsidies represent another means by which governments try to give their domestic industries an advantage in international competition. Such subsidies may take the form of an outright cash disbursement, tax exemption, etc. Other non-tariff barriers to free trade include licensing requirements and unreasonable product quality standards. By granting few licenses to import from other countries and by imposing unrealistically stringent product quality standards, government discourages import. A world of free trade will be one with no tariffs, quota, or any restriction on importing or exporting. In such a world, a country would import all those commodities that it could buy from abroad at a delivered price lower than the cost of producing them at home. Now suppose that a country imposes a 20% tariff on all imports. This does not prohibit trade, but by making all imported goods more expensive, it affects the profit margin of import. Any foreign good that enjoys a cost advantage of less than 20% are now effectively prohibited, while imported goods that enjoy cost advantage in excess of 20% will still be in demand. But Because their domestic price has increased, a smaller quantity will be demanded than there were no tariff. Argument for tariff and quotas. The most frequent cited non-economic reason for tariff is national defense. Because of the sensitivity of some industries to the economy, tariffs as barrier may protect them against foreign competition. Another reason for tariff is the need to protect infant industries. It is argued that because some industries are new, they cannot withstand foreign pressure. Foreign firms, the argument goes, are experienced and enjoy economies of scale, which enable them to charge lower prices than domestic industries that are still very new. While it may look reasonable, this argument is, however, widely abused. It has provided a cover for inefficient firms to continue to operate. Many of these firms, even after decades of their establishment, continue to claim that they are infants. 3. Tariffs are sometimes imposed to protect domestic jobs and to reduce unemployment at home. This argument is, however, criticized on the ground that it can lead to retaliation from other countries. It is maintained that without tariff, government can still achieve this objective through monetary and fiscal tools. The balance of payment. Trade transactions that take place between individuals give rise to two things. First, the exchange of physical goods or services, and second, the exchange of money between the transactions. As it happens in the case of individuals, so it is with international trade. The exchange of commodities between one nation and our trading partners necessitates the payment by the nation to our trading partners. A record which summarizes such payment is called balance of payments. This refers to the record of transactions between one country and our trading partners. In order to know what is happening to the cost of international payments, governments keep track of the actual transactions among countries. Every transaction, whether of import or export, is recorded and classified accordingly to the payment or receipt that would typically arise from it. Any item that gives rise to the purchase of foreign currency, e.g. paying for import, is recorded as a debit on the balance of payment account, and any item that gives rise to the sale of foreign exchange through export is recorded as a credit. One feature of balance of payments account is that it always balances. While it is possible for holders of Naira to want to purchase more dollars in exchange for Naira than holders of dollars want to sell in exchange for Naira, it is possible for holders of Naira actually to buy more dollar than dollar holders wish to sell. Every dollar that is bought must be sold by someone, and every dollar that is sold must be bought by someone. Since the dollars actually bought must be equal to the dollars actually sold, the payment made between the countries must balance, even though desired payments may not. This tool of international trade is divided into three. The current account. This records all transactions in goods and services. Goods, visible, are goods that can be seen when they cross international borders, e.g. cars, oil, cocoa, and groundnut. Services. They are invisible and they are things that cannot be seen, such as insurance and freight haulage and tourism expenditure. Other items under invisible are interest and dividend. When the country receives dividend and interest on loan and investment in foreign account, these are credited in our balance of payment and vice versa. The capital account. These record transactions related to movement of long and short-term capital. Capital movement may be divided in several ways. One important division is between direct and portfolio investment. Direct foreign investment occurs when firms transfer funds in order to create new capital in foreign countries. Portfolio investment, however, occurs when equities or bonds are purchased. If, for example, a Nigerian sales and buys a share by an American company, this is a portfolio investment and it represents a debit item on Nigeria's balance of trade. Capital movement may also be classified according to their term. Purchase of bond in another country may be termed long-term capital outflow. However, a deposit may be classified as short-term since the foreign account has the obligation to pay the deposit on demand. Official financing. These represent transactions involving the central bank of the country whose balance of payment is being recorded. There are three ways in which credit items may occur on the official financial account. First, the central bank may borrow from IMF. This represents a capital inflow and it does a credit item on the balance of payment. Second, the bank may borrow from other central banks. Third, the bank may run down its official reserves of gold and foreign exchange. This is a credit item because it gives rise to the selling of foreign exchange and the purchase of naira. The fundamental relation among the three main divisions is that their sum must be equal to zero. That is, the balances in the current and capital and official statement account must be zero. Why this is possible and what happens in most cases is that a country might have surplus or deficit in the current account. A deficit occurs when the value of the country's import exceeds our export. This deficit must, however, be matched by a net surplus on capital plus official settlement account, which means borrowing abroad or running down exchange reserves. In normal terms, when we speak of balance of payment, deficit or surplus, we refer to the balance on some parts of the account. Usually we refer to the balance on current plus capital. Balance of payment deficit has been the bane of many developing countries, including Nigeria. It has led to increasing foreign indebtedness of these countries and a massive depletion of their foreign reserves. Ways by which deficit on the balance of payment is resolved include devaluation of local currency, borrowing from IMF and other international organizations, depleting of foreign reserve, import substitution, and export promotion. A hypothetical balance of payment for Nigeria: visible export 55.54, visible import that will be less 53.32, invisible credit is 30.56, debit subtracting 28.70. Current account balance, net investment in Nigeria, we have negative 6.31, net trade credit negative 1.42, net financial transaction 5.99. Capital account balance minus 1.74, balancing minus 3.42, balance of payment minus 1.18, financial financing minus 1.18. The choice between domestic and foreign assets. Openness in financial market implies that financial investors face the choice of holding domestic versus foreign assets. It might appear that we have to think about at least two new decisions: the choice of holding domestic versus foreign money and the choice of holding domestic versus foreign interest paying assets. But remember why people hold money: to engage in transactions. For somebody who lives in Nigeria, whose transactions are those mostly or fully in Nigeria, there is little point in holding foreign currency. It cannot be used for transaction, and if the goal is to hold foreign assets, holding foreign currency is clearly less desirable than holding foreign bonds. It can be used for transaction, and if the goal is to hold foreign assets, holding foreign currency is clearly less desirable than holding foreign bonds, which pay interest. Thus, the only new choice we have to think about is that between domestic and foreign interest-paying assets, let's think of them for the time being as domestic and foreign one-year bonds. Consider, for example, the choice between US and German one-year bonds. Suppose that you decide to hold US bonds. Let it be for 1 year US nominal interest rate in year T. Then, as table 12.1 shows, for every dollar you put into US bond, you will get 1 plus IT dollars next year. Suppose you decide instead to hold German bonds. To buy German bonds, you must first buy Dutch mark. Let ET be the nominal exchange rate between the dollar and the Dutch mark. Thus, for every dollar you get, 1 over ET times DN. Let I-T denote the 1 year nominal interest rate on German bonds in Dutch mark. When next year comes, you will have 1 over E over T times 1 plus IT. ET plus $1 next year for every dollar you invest. This set of steps is represented in the second table below. In assessing the attractiveness of German bonds, you cannot look just at the German and US interest rate between this year and next year. Let's assume that you and other financial investors want to hold only the asset with the highest rate of interest. In that case, if both German and US bonds are to be held, they must have the same expected rate of return, so that the following arbitrage relation must hold. Equation 8.1 is called the uncovered interest parity relation, or simply the interest parity condition. The assumption that financial investors will hold only the bond with the highest expected rate of return is obviously too strong for two reasons. First, it ignores the transaction cost. Going in and out of German bonds require 3 separate transactions, each with a transaction cost. Second, it ignores risk. The exchange rate a year from now is uncertain. Thus, holding German bonds is more risky for a US investor than holding US bonds. But as a characterization of capital movement among the major world financial markets, it is not far off. Small changes in interest rate and rumors of impending appreciation or depreciation can lead to movement of billions of dollars within 1 minute. For the rich countries of the world, the arbitrage assumption in equation 8.1 is a good approximation of reality. Other countries whose capital markets are smaller and less developed, or have various forms of capital control, have more leeway in choosing their domestic interest than is implied by equation 8.1. To give a relation between domestic and nominal interest rate, the foreign nominal interest rate, and the expected rate of depreciation. Remember, that an increase in E is a depreciation, so that ET plus I minus ET over ET is the expected rate of depreciation in domestic currency. If the domestic currency is expected to appreciate, then this term is negative. The theory of exchange rate. So far, in this study session, we have examined international trade and the balance of payments. In this session, we will be more concerned with the medium of exchange in international trade, that is, foreign exchange. Exchange rate simply refers to the rate at which a country purchases foreign currency and sells our currency respectively. Alternatively, it is the price of one currency in terms of another country's currency. For example, 180 naira exchanging for $1. Determination of exchange rate. In today's world, exchange rates are determined in highly competitive free markets by the forces of demand and supply, and these rates change often to reflect the underlying demand and supply relations. For the purpose of illustration, we assume two countries model, Nigeria and the US. Therefore, in this market, there are only two groups of private traders: people who have naira and $1 trade with people who have dollar and $1. Also, for the moment, we assume that the Central Bank of Nigeria does not intervene in the market. Demand for dollars. The demand for dollars arises when holders of naira wish to make payments in dollars. This arises from imports of American goods and services into Nigeria and from capital movement from Nigeria to America. The supply of dollars. Dollars are offered in exchange for naira because holders of dollars wish to make payment in naira. The supply of dollars on the foreign exchange market arises because Nigerians export of goods and services to America and because of capital movement from America to Nigeria. The demand for dollars is downward sloping. This indicates that as the dollar becomes cheaper, holders of naira will demand more dollars in order to buy American goods. The supply curve for dollars is upward sloping. This indicates that as naira becomes cheaper, holders of dollars will offer more dollar in order to buy naira with which to buy Nigerian commodities. The equilibrium exchange rate is determined at the point of intersection between the demand for dollar and the supply for dollar. Assume that the current price of dollar is too low, say 30 naira to a dollar. At this exchange rate, the demand for dollars exceeds supply. Thus, some people who require dollars to make payment to America will be unable to obtain them and the price of dollars will be forced up. The value of the dollar vis-a-vis the naira will appreciate, or alternatively put, the value of naira vis-a-vis the dollar will depreciate. Causes of change in exchange rate. Number one, differing rate of inflation. All things being equal, the exchange rate of countries with high inflation will be depreciating, while those countries with low inflation rate will be appreciating. Number two, capital movement. Major capital flows can exert major influences on exchange rates, appreciating the currency of capital importing countries and depreciating the currency of capital exporting countries. Structural change. At the existing price level, an economy can undergo structural change that affect the exchange rate. If the structural changes have a positive impact on the cost structure, reducing cost of production, for example, through innovation, the value of the currency might appreciate or vice versa. Central banks' management of the exchange rate. In the previous subsection, we considered exchange rate that are determined purely by the market forces of demand and supply. However, in reality, we know that only very few countries allow its exchange rate to be left solely to market forces. More often, countries through their central authorities influence the exchange rate of their country. Fixed exchange rate. Under the Bretton Woods system that lasted from 1944 until the early 1970s, government did not allow their currencies to fluctuate freely on exchange markets. Usually, the rates were fixed within very narrow margin. Each government stated an official price for its currency, usually in terms of dollars, which was called the country's per value. The central bank then entered the market, buying and selling whatever quantities of foreign exchange necessary to maintain this par value. Such an exchange rate is called a fixed or pegged exchange rate. When it is changed, the country's currency is said to be devalued or revalued in case of a fall or a rise in its par value, respectively. An example will suffix this. Assume the fixed exchange rate is 70 naira to a dollar. However, for some reasons, the demand for dollars increased such that it is greater than its supply in the market. Normally, we expect the exchange rate to change. To prevent this, the central bank might enter into the exchange market and sell sufficient dollars to make demand equal to supply at the fixed rate. Fixed exchange rate. Even with the collapse of Bretton Woods Agreement, when countries no longer fix the par value of their currency, they still try to influence the exchange value of their currencies. They use various tools to achieve this. First, the bank can attempt to influence the long-term equilibrium exchange by various forms of payment restrictions, thereby curtailing the demand for foreign exchange. Second, the bank can attempt to smoothen out short and medium-term fluctuation in the exchange rate by open market purchase and sales of foreign exchange. Third, through the manipulation of interest rate, the monetary authority try to influence the flow of capital in and out of the country, thus influencing the exchange rate of their currencies. Nominal exchange rate. Nominal exchange rates between currencies are quoted in two ways. One, the number of units of a foreign currency you can get for 1 unit of a domestic currency. Two, the number of units of domestic currency that you can get for 1 unit of foreign currency. Following the example given earlier, the nominal exchange rate between the dollar and the naira is 108 naira for $1, or equivalently $0.008 for a naira. In this study, we shall define nominal exchange as the number of units of domestic currency you can get for 1 unit of foreign currency, or equivalently as the price of foreign currency in terms of domestic currency. We shall denote it by E. For example, when looking at the exchange rate between Nigeria and the United States from the viewpoint of Nigeria, so that the naira is a domestic currency, E would denote the number of naira one can get for $1. Thus, from our exchange, 118. We shall then write E for short as the naira per dollar exchange rate. To convert naira into dollar, simply divide by E. To convert dollar to naira, simply divide by E. Exchange rate between foreign currencies and naira change every day. Indeed, every minute during the day. These changes are called nominal appreciation or nominal depreciation. Appreciation or depreciations for short. An appreciation of the domestic currency is an increase in the price of the domestic currency in terms of a foreign currency. Given our definition of the exchange rate as a price of the foreign currency in terms of domestic currency, an appreciation corresponds to a decrease in the exchange rate E. This is more intuitive than it first seems. Consider the naira and dollars again from the viewpoint of the naira. An appreciation of the naira, also called a naira appreciation, means that the naira's value goes up in terms of dollars. Equivalently, the dollar is worth fewer naira, which is the same as saying that the exchange rate decreased. Similarly, a depreciation of the naira or naira depreciation means that the naira is going down in terms of the dollar and thus corresponds to an increase in E. That an appreciation corresponds to a decrease in the exchange rate and depreciation to an increase will almost surely be confusing to you. At first, it confuses many professional economists, but it will eventually become second nature as your understanding of open economy, macroeconomics deepens. Until then, you will find it useful to consult Table 3.1 below, which summarizes the terminologies. Study session summary. In this study session, we examine the importance of international trade to economic development of a state. In the process, we discuss two theories of international trade, the theory of absolute advantage and the theory of comparative advantage. The theory of absolute advantage states that a country should export those goods in which they have absolute advantage and import those in which they have absolute disadvantage. Richardian trade theory, however, states that comparative advantage rather than absolute advantage should inform the basis of trade. You also studied barriers to international trade. We observed that despite the immense benefit that could be derived from international trade, many countries continue to impose barriers like tariffs and trade quotas on free flow of trade. Several reasons, such as the need to generate revenue, protect infant industries, maintain national defense, and etc., had been adduced for this. You went further to explore the balance of payment as an important tool of international trade. In the process, we discussed the three discussions of the balance of trade: the current account, the capital account, and the official financing. Lastly, you learned that exchange rate is the price at which a country's currency exchanges for another. In a pure competitive market, exchange rates are determined by the forces of demand and supply, independent of any institutional interventions. There are three possible exchange rates. We have the floating, the managed, and the fixed rate. This is the end of study session 8. Thanks for listening.